So we're going to dive in. Drea is here. So she, like I said, she works with the property management companies and is involved in our technology, which we'll talk about in just a little bit. And she's going to help me. She's going to help me run this meeting, and she's going to keep track of all of your questions. So a couple of things up front. Dre, you want to hit them with what we want to do with questions. We're going to have a Q&A at the end. Let's just,
yeah, go ahead. Yeah, absolutely. So essentially, I'm going to be in the chat with you guys too today. I just put one in there. But before Ron gets going, like, let's find out how many rental properties you guys currently own. Just drop the number. And if you don't want to say, there's no pressure. Nobody's twisting your arm or, like I say, to give it chicken wing. That's what we did as kids. But yeah, if you guys have any questions at all, drop them in the chat and I will get to them as soon as we can. I'll flag them. I'll interrupt Ron whenever it makes sense. And if we don't get to them during the conversation, we're definitely going to have a Q&A at the end of it. So feel free to let us know what you got going on, and let's make this happen. I'm excited.
Awesome. Okay. And so stick around to the end, because if I don't answer the question during, or if Drea doesn't answer the question during, we're going to save some time at the end. So today, for those of you who don't know me, I don't really want to talk about myself that much. I've been doing this for a long time. And as you can see in the chat, I know some of the people. I've helped a lot of people invest in real estate over the years. Our company, Lineage, has a very deep bench of people who've been in the industry. Dre has been in the industry for, I think, over 10 years. We have a lot of people who've been in the industry for a long time. And I already told you I was a grandfather, so I'm very proud of that.
I will say that grandparents, I've even noticed it with my family, my parents. Like, I was chopped liver once those grandbabies came along, and I'm like, wait a second, I'm still your kid. So there is something super special about being grandparents. So other than that, I know that real estate's your second love there, Ron.
Okay, so guys, this is what we're going to talk about today. Why real estate's best wealth preservation tool, and growth, in my opinion, growth strategy, ownership. We're going to talk about a whole bunch of different things. Before we get started, really quickly, Lineage. Lineage is, we've helped a lot of people. We've developed some technology, and that technology makes it so much easier. I was just talking to a guy yesterday who's super frustrated trying to figure out what all of his properties are doing because they're in different areas. He gets different reports. One of the things that Lineage does is pull all that data together so that you guys can have all of that at your fingertips all the time. But we also help people actually execute, not only growing their portfolios, but optimizing their current portfolios. And as you can see, we have people who have no properties and are here to learn. And we have people who have 50 plus properties who are here because maybe they want to optimize their portfolio or figure out how they can scale their portfolio even more. We're going to talk about some of that stuff today. But I want you guys to understand, like, we're going to do, we only have a short amount of time, so I'm going to dig into this, but be thinking about topics that you guys want to learn about. We're going to put this thing on repeat, and we're going to have this, and we want this built around what you guys want to hear, what you guys want to learn. And so with that, I'm going to jump into it. So why in the world have all of these people invested in real estate, and why should we continue to invest in real estate? So here are the reasons. Now I'm going to dig into each one of these, but just take a look really quick. There's 10 reasons, and I'm sure I'm missing a few. So if I'm missing some, and you guys that have been doing this for a while, if I'm missing some on this list, put them in the chat. Let me know what I'm missing. I'm going to dive into each one of these, but no one of these is unique, right? But all of these together is the most unique thing that I've ever seen. And if there's another asset that does these things, or more than these things, please let me know. The first thing I want to talk about is ownership, right? If you compare this to any other investment out there, you're 100% owner. So that means you get to make all of the decisions. The deed is in your name. So all the people that you're seeing on here who have all of these properties, they get to make the decisions. And so when you own real estate, you're the CEO. You're not actually, you don't own a stock where there's a CEO who's making decisions that you have no input. You are the CEO. You get to make all of the decisions, and you need a team to be able to help you out. Andrea, I mean, you can probably talk about the quality of the partners that we work with in the property management world. That's your team. Mm-hmm. Choosing that team to help you as the CEO of your property to manage your assets is really important. Andrea works directly with them.
Yeah. Yeah. If you're one of our property management partners joining us today, like, first and foremost, thank you. A good number of the people on this call are here because you told them about it. So you saw the value in this kind of education and passed along to your owners. And that is exactly the kind of partnership we built this around. And it doesn't necessarily happen without you. And like I said, I am gearing towards the property managers because that is where I live in this business. So I just want to explain why we work with these property managers the way that we do for your guys' sakes as well, because I think it explains a lot about how Lineage operates in general. And one thing is like, Lineage is not managing your property, right? So we're not building a competing management arm with these property managers. Like, we are partnering with them to be able to help the owners buy their next property, or the investors through us, and then taking it back to the property managers. So the nice thing about this is that these property managers that we work with, we vet them. We make sure that there is an appropriate relationship that our investors are going to be able to capitalize on. And that way they can just keep thinking about you can keep thinking about your next purchase. And then having somebody be able to be trusted in order to help them out on that part. So I think the most important thing about this for all of you investors on this call is, like, most property managers don't necessarily just have everything all under one roof. Like, they're working with partners on the regular to be able to provide value. And that, to me, is exactly why we are partnering with these property managers, because they want to make sure that their investors are taken care of. And so that's just the beauty of it. And we're able to work with all of you investors to be able to talk about the things that Ron's going to be discussing today. So that's hopefully that gives an explanation of what you're looking for, Ron.
Yeah, I appreciate it. Property managers are the unsung heroes, and they're the people who actually make things happen for your assets. And so you're the CEO. They're the people who are actively managing the assets. Mm-hmm. But you also get to personally influence the value of your property. You can do that in a number of ways. But the most important thing is, what you do and say online doesn't affect the value of your property. So if you get busted on a cam, with somebody you're not supposed to be at a concert, it doesn't hurt the value of your property. Not saying you should do that, but no CEO, no matter what they do, can crash the value of your property. You can actually add value to your property. However, you can do upgrades, you can do additions to the property. A lot of times in California, they'll do they'll blow the top out of the house and build a story on, because there's no land left. There's a lot of things that you can do to increase the value of your property, not the least of which is just the operations, like we were talking about with the property managers, to increase your net operating income, right? And then, of course, you have high growth opportunity, and you have dividend opportunity, which we call in real estate, we call it cash flow. And I want to talk about cash flow first. Right now, cash on cash returns are somewhere between 6 and 9%. It depends on what kind of properties that you're buying, whether they're new or not. We're not going to dive into a bunch of that. But it generally speaking outperforms any other dividend producing stock that you would get. Now, where I want to spend a little bit of time is on appreciation. And this is something that people don't, a lot of people don't understand. And the next slide, I'm going to talk about leverage, and I'm going to call back to this number. But take a look. You at 3%, if you buy a property with 20 or 25% down, which most people do, that 3% is actually a 12 to 15% return on investment because of the money that you actually invested into the property. So there's massive growth opportunity. That growth opportunity is increased by leverage. And then it's compounding, because every single year, if you buy a $250,000 house and you have a 3% appreciation gain on that, next year, the appreciation rate is being calculated on the new price with the appreciation from the previous year. So it's a compounded rate of return. And so anyway, same thing. Stocks, you can have high growth stocks, you can have dividend producing stocks, but not ones that you own 100% of unless you started the business. So all of these things combined together is what makes this unique. And this is a unique one too. It is very normal for people to buy real estate leveraged, meaning use debt and use cash to be able to purchase a piece of real estate. And while you can do that with stocks, it's not very typical. It's not common. And so you can purchase this with fixed debt. So you're not chasing the debt around. And that means the banks are locked into it no matter what inflation does. It's a great hedge against inflation, because you can lock in your rate. And if the interest rates go up 4 points, the bank is still stuck with your debt. And we have a lot of people in that situation right now where they have a 3, and some of them 2.5%, 3.5% loan. The bank is stuck with that until those people sell that house. And rates are double that today, right? So inflation reduces the cost of that capital that you have borrowed. And then something really unique about real estate, which a lot of people, again, don't think about, but they know it's happening, is you have a resident inside of your house that pays you rent every month. And those people are net effect paying your debt. They're paying off your loan. And so when you think about cash flow, you have to think about both parts of the cash flow. If you have a fully amortizing loan, part of your cash flow is going to build equity in the property through principal reduction in your property, and part of the cash flow you get is cash. If you don't have a fully amortizing loan, but you have an interest only loan, you get all of the cash flow, and then you get to choose what you want to do with it. You can still pay your principal down with building equity, or you can keep the cash flow in your pocket. So both of those loan types give you the ability to do both of those things, right? Reduce and build equity. So as the property increases in value, you owe less, and of course your equity. We already talked about appreciation, but you also have principal reduction that is working at the same time, and both of those things together are building equity inside of your property. And again, if you guys have questions, feel free to. Sorry, I was just seeing questions come in and see if they're relevant. We'll get to these at the end, I promise.
I'm saving them, Ron. I promise.
I appreciate it. So risk mitigation. This is also something that's really unique. I mean, tell me another opportunity where you have such downside protection, right? It's because you have land underneath your property. Even if the house burns to the ground, it's not worth zero. But companies that burn to the ground actually do hit zero. You're insured against downside risk. You can actually buy insurance. I'm sure everybody who said that they own properties has insurance, so that if it burns down, not only does it never go to zero, but they're insured against that loss. So you can just build it back, right? So you can insure the structure. You can also insure the income. because if you have the appropriate insurance policy, it's going to give you loss of income while you're building the house back, right? So there's massive downside protection inside of real estate as well. And before you buy it, I mean, think this through for just a second. Any other asset class that you buy, how many times do you get an independent verification from a third party that says, yeah, that's actually the right value? Or no, that's actually not the right value before you buy it? Almost none. And how many of those, like, how many stocks have you ever bought where they give you an independent third party inspection of the inner workings of the company to make sure that that company is strong? Well, in real estate, you get a third party inspection from somebody going there and make sure that the house is solid, the foundation is where it's supposed to be, everything's up to code, along with the independent valuation. And then depending on what you're using for your loan, you can get yet another validation, because debt service coverage ratio loans, those are structured around the income of the property and whether the income can cover, which is why it's called a debt service coverage ratio loan. You can actually have a bank that says, yeah, actually, this is a good investment, and it's a good enough investment that we're going to give you a loan on it, and here are the terms, based on how well it covers the payment and the operations of the property itself. So you can have 3 different independent verifications that you're making a decent decision when you're buying your investment real estate.
And Ron, I'll stop you there. Luke had a question about that. So what are some of the downsides of the interest-only loans? Would you ever recommend not doing this with any of your properties?
Yeah, I love interest only. And somebody asked a question about commercial too. So I'm going to try to put some commercial in here real quick. So on all of the apartment complexes that I ever bought, I tried to get as long of a term of interest only as I could. And the reason for that is because I want to control what happens with that cash flow. Because you remember I told you when you're in a fully amortizing loan, it's a forced use of the cash flow, right? You have to pay the interest piece of it in either one of those loans, but the principal piece, that's a forced savings account. So it's very similar to a 401k, right? So if you're a person who uses a 401k and you force savings into that 401k because you shouldn't put the cash in your account because you'll spend it, well then, probably principal and interest is great. However, one of the main things cash flow is for is running your business. So if you think about this as a business, you need capital to be able to run the business. And if a property is producing a lot of cash flow because you're using an interest only, and that year you happen to have higher expenses, well, then all of a sudden you can make a choice to go, okay, well, I don't want to pay that money into the principal reduction because I need to use that capital to run my business. That way I don't have to take it out of my pocket to do it. So the property is being self-sustained. But you can always take that cash flow and pay it down on your principal reduction. You can do that either way. So interest only just gives you choices that you don't necessarily have. And the reason that I did it on my apartment complexes is because I wanted to build up. Because if you think about it, single family home has 1 air conditioner, has 1 water heater. Well, 90 unit apartment building has 90 of those. And so I wanted as much capital in the account as I could possibly have to run those businesses. Okay. Really, really important. So hopefully that answers the question. And look, I put a little bit of commercial in there, just a tiny bit. We can do more.
Yeah, she had mentioned, Anne, she says, do you guys mostly talk about residential properties, or are there ever conversations here about larger commercial deals and investments?
Yeah, mostly 1 to 4 unit, but we have, let's answer that one at the end. Because yes, we do. And I just told you, Ann, that I buy apartment complexes, but mostly what we do is 1 to 4 units. So duplex, fourplex, things like that. And one of the other main reasons why people invest in real estate is for the tax incentives. And it's pretty cool that you have an appreciating asset that the government allows you to depreciate off of your taxes. Which, if you're cash flowing on your properties, and I know a couple of you in there were talking about not necessarily that didn't necessarily happen for you over the last year or two, whatever it was. When it does happen, when you do have positive cash flow, I don't know of any other asset class. I don't know very many other asset classes where you can actually write that income off using depreciation. And the way that it typically works is you depreciate the structure, so not the land, because again, remember, if the structure burns down, the land is still worth something. So the government won't let you depreciate that, but they will let you depreciate the structure. So over 27 and a half years, you get to depreciate this structure. Okay. And that's called straight line depreciation. So it's like 3.63% per year. There's also what's called accelerated depreciation. And I don't have time to get into exactly how this works and run through all of the numbers. We could do that in a different, in a future lunch and learn if you guys want to. But accelerated depreciation is a way that you can take the parts of the structure, break them down, and you can accelerate depreciation pretty massively up front, especially with some of the way that the tax code is written right now. And this offsets other passive income that you can have, right? So it creates passive losses, offsets passive income. So if you have other income that's passive income, this is something that you should look at. And if you've never heard of that before, you should reach out and we can talk to you a little bit about it. But you get to depreciate either one of these ways. You get to depreciate your off of your taxes, and so you shouldn't pay taxes on the cash flow that you get from the property. So now we are going to open up the floodgates on these questions because and I also want to tell you guys, not just the questions, but as we've gone through this, I know some of you are going, I really want to know about this, and I really want to know about that. Okay. Our next scheduled lunch and learn is going to be about the 4 returns, how to calculate them, what they mean, and what they mean to you. If you want to hear and learn about something else, please put it in our chat, right? Put it in there, and so that we can so that we've got it. And then we're gonna start to cater all of these meetings to what you guys want to learn, not necessarily what I want to teach, right? So what you guys want to learn is what we're going to talk about. All right, Dre, let's start doing a rapid fire on these questions, and I'll answer them as we go. And as I'm answering the questions, if you guys have another question, you're like, oh, well, that makes me remember this other question, just post it in there, and we'll hit them as long as we got time.
Perfect. Well, we'll go back to the beginning. So what markets do we operate in, Ron?
Oh boy. Several. I think we're in 10 right now. And I'm going to not remember some of them, but we're in North Carolina, we're in South Carolina, Florida, Alabama, Tennessee, Georgia, Oklahoma, Missouri. There's more, and I can't think of them right now. But if you go to our website, you can see what they are.
I was just gonna say I was gonna drop them in the chat as well.
And guys, those all of the areas that we're in and the areas that we've been in over the years, we move in and out of areas based on what's happening with the market and also what's happening in that area. So we have suppliers in each one of those areas, both new construction, so builders, and also rehab companies. And depending on the levels of inventory that we can get in those areas, the flow of inventory and opportunities shifts. And the other thing is that it shifts with markets, because I've been doing this since 2005. So I went through the crash, and prior to the crash, markets were way different than post the crash. Like after the crash, we went into all of the markets that were crazy appreciating, that had completely fallen apart, and bought them because they were cheap then, and you could make the numbers work. Wasn't very many years after that, because those markets also spike really fast, that they didn't work anymore, and we pulled back out of those. And then it wasn't very many years after that where we were starting to help our investors do 1031 tax deferred exchange out of those markets into other markets and expand their portfolios. So this is a shifting thing based on the markets. And hopefully that answers your question.
Well, and that just leads into perfect with Steve's question. It says, so if you want to do another 1031 exchange down the road, paying interest only will affect how many properties I can purchase with one property? Question mark. I won't have as much in equity to roll one property into two properties paying interest only on a 1031 exchange, correct?
Steve, I'm going to make an assumption, and if it's not the right assumption, just hit us in the queue. So yes, if you're not using your cash flow ultimately to pay down principal or keeping it in the bank, right? If you don't put that money into the principal, then when you do your exchange, that money would not be part of the exchange. I think that's what you're asking me. And if it is what you're asking me, then the second piece of what I explained with respect to interest-only loans is an important one. You can always pay down principal. It's your choice on an interest-only loan. On a fully amortized loan, it is not your choice. You have to make that payment. So a guy like you, and I think it was Steve Van And if it was, then Steve, you're a person who can control yourself. There's no reason why you couldn't use an interest-only loan and then take that money and actually pay down the principal so that it's usable in a 1031 exchange. That's a great question and a savvy question. So all of you folks on here who are new, there's folks on here who've been doing this a hot minute and that have been through an exchange or two in the growth of their portfolio. You can tell because there's people on here with dozens of properties. That's a savvy question. Hopefully you guys learned a little bit from that question. Go ahead, Andrea.
We've got Bob. He says, I have been advised to pay less than 20% down payment, but have never been comfortable with it. What is your take on negative AM loans?
Negative AM loans? I don't like negative AM loans. I think that I don't think so. Let me just rewind the tape because I lived through the last crash. Negative amortization loans, if you don't know what that means, it is a loan that takes some of the amortization that you would normally pay down and it puts it on the back end of the loan. And it makes the payment very low and it makes a property cash flow. But back in 2005 to 2008 through the crash, a lot of people were buying houses that way. In addition to that, back then you could get 100% financing negative amortization loan with basically no documentation. It was insane what was going on back then. You see a little bit of that sneaking back in. Frankly, I think what reset after the crash, where people still had to bring 20% down and 25% down to buy properties, was sanity coming back into the market. And so my perspective is don't over leverage yourself. Instead, buy where the numbers make sense. Let an awesome property manager manage it for you if it's outside of your area. And even if it's inside of your area, because who the heck wants to manage a property by themselves? There's these crazy people who love it called property managers. You should let them manage it for you. And hopefully that helps a little bit.
Well, and then we've got another 1031 question. So any creative ways to build a portfolio quicker and more effectively through Lineage? Currently using a first lien HELOC on my primary to finance deals, selling one of my properties locally and hoping to do a 1031 into two properties with Lineage.
There are so many ways to skin that cat. I'll run through a few. So you already have a first position HELOC. Okay, so that's in essence cash out of a property. You have another one that you're selling. If you hate that property and it's not performing and you don't want to keep it anymore, then selling it in 1031 exchanging can be great. I don't know anything about the situation, so I'm just going to say a whole bunch of things. You could also do a cash out refinance on that property, and still allow it to cash flow and purchase other properties that cash flow. And in that scenario, you don't need to do a 1031 exchange, and you also don't have to relinquish your asset. You can keep it. So if it's an asset in an area that's still going up and it performs, you could just keep it and buy more assets. Plenty of people do that. And I'll just state again, don't go over leverage yourself. And if you use debt service coverage ratio loans, then the bank is going to check you on your math anyway, right? So there's two ways to make it happen, and I'm sure there are other ways to make it happen as well. Working with us, we can help you through eating one of those. Guys, we have done hundreds and hundreds and hundreds of 1031 exchanges. And we've even done 1031 exchanges when people show up and they're like, I have 2 days left to identify, and like, can you help me? Yeah, we can help you, right? We prefer not to do that, but we can. We're very good at 1031 exchanges. And part of the reason is because the properties that are on our marketplace, we've already pre-negotiated those. So, if they work for whatever you're trying to accomplish, then we can just put them under contract and we can close them, right? So there's no issue there. And a lot of these, we've done the 95% rule, and we hit the 95% rule, which almost everybody tells you not to do, because if you're going out there negotiating your own deals, they can fall apart. Ours don't fall apart like that. And so we've helped a lot of people with the 90% rule or 95% rule. So anyway, hopefully that helps.
Most of the questions here, Ron, and maybe you'll get more into this as the conversation goes on, but they're very specific towards Lineage in general. So I didn't know if you'd be covering more on that, or if you wanted to answer
what
them
are
now.
they specifically? I'm happy to talk a little bit more about Lineage and what we do and how we help people, if that's what the direction of the questions are.
Yeah. Yep. So one of them was, can you please give a little more detail about your Lineage and what you guys do? So there you go.
Absolutely. So Lineage exists to help people, like I said earlier, optimize current portfolios, scale portfolios, and help new people begin the process of creating a portfolio of real estate investments. And we make that very, very simple because, well, before I get to the simple piece, we also help you manage and track performance of your assets in a portal that you can see how the performance is in real time. So we connect to property management software. We can download all of that information, and then we have third-party softwares that we can provide you the full returns we're going to talk about next week, all in a dashboard that's super easy to understand. Okay. And then what we do, how we do all of this is we have a marketplace of vetted properties from vetted sellers. Those properties all have pro formas. You can see what the numbers are. We get the rents from the property managers who are going to be managing them, so that we know we've kind of verified the numbers. Internally, we have a lending arm. So when you're looking at a pro forma, the lending that is the loan piece that's on there is an actual loan we know that you can get. It's a debt service coverage ratio loan. So for those of you who don't know what that is, it looks at your credit, and then it looks at the property itself. So can the property support this loan? And if it can, which we already know that it can, otherwise it wouldn't be on our site. Since it can, you can just say, okay, that one actually looks good in that area. This is the one I want to start with, or this is the few that I want to use for the exchange. And then it goes directly into lending, which is also in-house. So we can share all of that data, and it's just less effort. It's less of a lift on your part. The insurance quote that's in there is real insurance. It's from our insurance department. And the reason that we've done all this is so that we can compress the timeline and so that we can make it so that it's much, much easier for people to do this. Most of the people we work with are busy professionals, business owners, people who don't have a lot of time. And they also don't know how to invest out of state. And a lot of this is out of state. And then we combine all of that with an awesome property manager. So as soon as you get through the closing process, it's already being managed by a professional manager who can be that teammate that you need as the CEO of your new real estate business. So hopefully that was clear. And then one thing that is a next logical step question is, why the heck are you doing this, and how the heck do you make any money? And it's really, really simple. 20 years ago or so, I came up with a way that we can make money without having to charge any of our investor clients money. And it's super simple. The real estate world is based on realtors making commissions. So all we do is we just make a regular realtor commission. So when we go out to negotiate deals with these sellers, we get to use all of the buying power of all of you guys to negotiate great deals and great rates with the lenders and great insurance rates. When you combine all of that, it gives a competitive advantage where you guys can get really good deals from us, and you don't have to pay us money to get those deals because the seller is paying. We're making a little bit of money on the loans, and we're making a little bit of money on the insurance, and it just makes it so that everybody gets to win. That's how Lineage works in a nutshell. I think the number that we're most proud of is that 71% of the people that buy from us one time continue to buy from us. Some of them are on this meeting with us today, and that's what makes this thing ultimately work, right? Is that we try to do a really good job for everybody. Yeah, well, yeah, I'm sorry, Lane. Thank you. We charge one fee. Apologies. Thank you, Lane, for the call out. We charge one fee, and actually, it's $750 now, Lane. So the only fee that we charge for anything that we do, everything that you hear about Lineage, that's the only thing that we charge the investors, and it's basically just a processing fee to pay the people who are helping with the loans to go through. And so one of the cool things that we do is we do investment plans so that people start out with an idea of what they want to do and a plan to move forward. And then we just help you guys execute the plan. That's really the end of it. Thank you, Luke. I appreciate that. And thank you, Lane. Guys, I would have missed that. And somebody would have said, you said.
Lane's keeping you on track, tried and true.
So I appreciate it, Lane. And thank you, Luke. Appreciate that too.
Yeah.
So what other questions we got? We got like 4 minutes left. I don't want to keep you guys
all right.
longer.
So real quick, does it pull in info from properties not purchased through you?
Yes, if we're connected to your property manager, which if your property manager invited you here, then we're already connected. And all you need to do is just reach out, and we can walk through the portfolio with you and show you how it works. So you know how that works too. Your property managers have provided that for you guys, right? So I mean, that's the way that works. Yeah.
We have another question of, what are your thoughts on co-living spaces? A follow-up is, could your properties be converted to co-living spaces or short, mid-term?
So long as the local laws don't prevent it, I think any property can probably be, yes, we love block. So Bob, reach out. We can connect you and show you how your portal works, for sure. There's not a ton of, it's kind of a new thing. I know it's not like brand new, but it's kind of a new thing. So these co-living, so there's sites called Pad Split, and there's some other ones that are popping up. I do think it's probably going to be something that becomes popular just because of affordability. I don't have enough information to say that it's a great thing. I know of some government style ones like that, and those that I've heard of did not go well. but like pad split and things like that, I have some friends who are doing it. I just don't have enough information from them yet to know whether or not it actually is working well or it's not working well. So that's one I'm going to owe you an answer on. I literally don't know, but it's becoming more popular. I think as soon as affordability as soon as affordability takes care of itself, that's going to become less desirable. I don't know very many people who want to live with other people that they don't know, but for a little while, sure, I'm sure it's going to be good. Yeah.
Oh, we've got the questions just keep rolling through. And you
Yeah,
guys,
and
if
I'll
we don't
stay. I don't like, I'll stay and answer questions.
And I was gonna say, if we don't get to them, we'll make sure we get to them in one way or another if you have to jump.
Yeah, for sure.
So another thing is can you give more details about how Lineage operates with investors? Are you the lender on the deal, which I know you touched on a little bit. I don't know if you want to expand upon that, which the investor must find, or do you provide offering for your investors to buy into? And I know when you were talking about that, Ron, you also had brought up like the insurance side, and we had another question about like seeing the insurance quotes, which in companies you work with, etc.
Yeah, great. So those are great questions. Our internal numbers are between 95 and 100% of the people who work with us use our lender. It's both easier. It doesn't cost any more than working with any other lender, and we get great rates. But clearly, there's 5% of people who don't, so it's not mandatory. Same thing with our insurance. We have a master insurance policy. That master insurance policy, because of the types of properties that we sell, which are new construction or fully renovated, it keeps our loss runs low. Because our loss runs are low, we don't get insurance hikes every year. As a matter of fact, last year we didn't get a hike at all. One of the years that we've owned the book, we actually got a reduction. So it's a very easy way for us to be able to offer insurance. We know what the price is going to be. We don't have to get a quote because it's a master insurance policy, and so it's already in the pro forma. Our numbers on that are just north of 90% of the people who invest with us use our insurance. You don't have to. If it's not the greatest for you, then that's great. Thank you, Bob. Appreciate it. And you're working with Shane. Shane's awesome. So that's great. Lane, I don't even know what the fees are, buddy. I can't tell you right now, but if you're working with somebody, which I assume you are, have them get connected with our lending team, and we can tell you what the fees are. I mean, we're very competitive with everybody else in the market. Otherwise, 95% of the people wouldn't use us. But yeah, it just makes it so much easier because we have all of the data on the property. It all automatically gets passed over to the lending company. All we really need from our investors at this point is very limited amount of information that's super easy to gather. So it's very, very simple.
Roland asked a great question here. How do you deal with managers who keep you in a negative cash flow by making constant unwarranted repairs without telling you?
Well, so there's a couple of things I would say about that. Number one, I don't know your situation, and I don't know exactly what's going on. Well, I mean, we're happy to have a conversation with you about it.
Mm-hmm.
In my experience, there aren't very many property management companies who just do repairs for no reason. That doesn't make it any less fun when you have to pay for a repair. I mean, I have to pay for repairs too. It's not fun to have to pay for a repair. What I try to keep in my mind is if I have a property management company who's keeping my property rented and my property gets rent escalations every year and they're taking really good care of it, that asset growing in value, that's the piece that I care about the most. And that only happens if I have a property manager who's taking care of it. I can tell you that the worst kind of property manager you can have is when it doesn't give a crap about your property at all and lets it fall apart and lets you have a tenant in there that continues to trash it for years and years and years. And I have had that happen. I would have much preferred that they put a good tenant in there and that they kept track of it and repaired it as necessary so that I could keep that tenant in there. Um, Again, I'm speaking in generalities because I don't know what your current situation is. Um, if you think something's off, just have a conversation with your property management company. Um, I know we work with really good property management companies. That's what I'm used to. But I don't know very many property managers who get into the business because they don't want to help people succeed. And so, if you feel like something's off, the best thing to do, in my opinion, is just to call them and talk to them, because most of them are really good people, and they're doing the best job that they can. Ultimately, if that's not the greatest job for you, well, then you can find somebody else. I mean, that's your prerogative. It's my prerogative. Again, I told you, you're the CEO of your piece of property. If you think something's off, then the only thing I would tell you is a lot of times the grass is not greener on the other side. So make sure after that conversation that that's not actually what's happening, and they're not just like trying to take care of your property, because you could go to the other side of that deal and it could be not a great experience. So just get the facts. I mean, we're happy to talk to you too, but it's always good to just reach out to the source, I think.
Hmm. Yes. And I know I answered this in the chat, Vicky, but just in case you didn't see it, like what our relationship with Relevate Property Guides is, just as I was talking about earlier, these are property management companies that we have vetted to make sure that they're a good partner for us. We're a good partner for them. And so hopefully that's how you heard about us today. But we are having these conversations about your assets, your portfolio for you through them providing that opportunity. So, and just in case anybody else had that question, but the other question we have, Ron, is what are the benefits of going through Lineage to acquire rental properties versus go directly with the known turnkey provider?
Well, there. I mean, I've mentioned a bunch of them. Um, I think the main thing is, I mean, if you know the turnkey provider, you bought for them before, and you know, and they're fantastic and they did a great job. Well, I don't think there's anything wrong with continuing to buy from somebody like that. That's why I hope people continue to buy from us. Um, if they're new to you, I mean, one of the things that we do, which again I'm really proud of, is that not very many companies have 71% repeat business rate in this business. And the reason we have that is because we vet the sellers, and we try our best. I mean, real estate is real estate, guys. I'm not saying that things can't go wrong. I think anybody who's done business with us has had something go wrong. They would probably tell you right in the chat. Um, but we don't go anywhere. We always try to help where we can, and we're incentivized to do that because our entire business is built on repeat business. If there weren't any repeat business, then this wouldn't be a very good venture for us. And so I would just tell you, we've been doing this for a long, long time. We know what we're doing. We work with great partners, and we're always there. And so you've seen some of the comments that are in here that are, I mean, they can tell you better than I can why you should work with us. But mostly these lunch and learns for us guys is a great way for us to be able to educate folks, and help you guys want to continue to do what has been really, really good to me over the years. And like one of the last things I want to leave you guys with is it takes time in real estate to make money. And I've been doing this for a long time, and because of that, I have reaped the rewards. And you've seen a lot of people who are on here who have amassed very sizable portfolios. That typically doesn't happen in short term. That typically happens over time. Real estate over time is one of the best, other than building your own business, it is the best way to generate wealth and build real investment portfolio. We have any other ones, like final parting questions that I can answer?
One of the questions Anne has is, well, it says, so the Lineage dashboard is free to owners?
Yeah, absolutely. Lane already called me out. The only fee we charge is the one when you actually transact. It's $7.50. Actually, I think it's $7.49. Somebody's going to be like, "You were $1 off, Ron." It's like $7.50, and that's the only fee that we charge. So the reason that we have connected to the property management software is because over the last 20 years, we have found that it is very difficult for people to scale their portfolios because they don't have access to the information that they need to know how their properties are performing. They don't know what they're worth without calling a million people and trying to get, they don't really know what their cash flow numbers are, because the property management companies, they only have the expenses and the income that they have. They don't know what your mortgage payment is. They don't know what your taxes are. They don't know what your insurance is. So what we do is we combine all of that together, and we need, all of this only works if you have really solid property management companies. So it stands to reason that if we can connect technology to the property management software and get parts of that data, we can give you a true cash flow number, and then we can give you the other 3 returns other than cash flow, and we can give them to you very, very simply. And if you have, what we believe, what we know, is that educated people and informed people, well, they want to do more. And if it's easy for them to do it, they'll do it. So the whole premise of our business is a triple win. If property management companies win, we win. Actually, there's a lot of people that win. The sellers win, we win, you win, property managers win. Everybody's wins. And we've been doing this for a long time, and it just works over and over again.
Oftentimes I talk to people and they're like, this is too good to be true. And I'm like, it is. It's amazing. It's a win-win all around. And Lane had a question too. So who decides the cost of the loan, not the interest rate, the fee?
We do, and the lenders do. So there's fees that we can't control because they come directly from the investor that's buying the loan on the back end. And there's just administrative fees that we have in addition to that. And again, I don't know what they are, but if we can put you in contact with our lending company. And we really want this to be a great value add for you guys, to be able to help you grow your portfolios, manage and optimize your current portfolios, and just make this thing really, really work for you.